Hello, my name is Troy Atkins, and I am the founder and owner of Atkins Capital Management. I want to talk to you today about the key housing events that have transpired in the U.S. during the fourth quarter of 2017. During the fourth quarter of this year, the implications of the Tax Cuts and Jobs Act on residential housing and the actions of the Federal Reserve as part of its Federal Open Market Committee operations were the primary topics of discussion. This movie presentation also provides an overview of the home price level for a select group of cities that make up the Atkins 60 City Home Price Index, and it provides a wealth of information for prospective homebuyers to use in order to make a prudent home purchase decision. This presentation was written, narrated, edited, produced, and published by Troy Atkins. I am the founder and owner of Atkins Capital Management. Atkins Capital Management is a privately owned and independently operated company. Our exclusive focus is on residential real estate. Our company is not affiliated with any parties associated with the residential housing industry. Our mission is to bridge the gap in the residential housing market, where deficiencies in education, public policy, regulation, product structure, and personnel have created an environment where prospective homebuyers need objective information and useful analytical tools in order to help them make a prudent home purchase decision. As an investment professional, I have more than 15 years of real estate analysis experience, more than 10 years of institutional investment consulting experience, and more than 8 years of freelance financial writing experience. I am also the author of more than 25 published articles. For more information about my background, skills, and experience, please visit the Atkins Capital Management website. With this overview in mind, let me now turn your attention to the primary events that have transpired in the residential housing environment. For the fourth quarter of 2017, President Trump's signing of the Tax Cuts and Jobs Act bill prior to Christmas was the primary topic of conversation. The impact of the bill on the housing market and homeowners is at least threefold. First, the amount of mortgage interest expense that a homeowner can use to reduce his or her taxable income amount will fall. The bill lowers the tax deduction amount that homeowners can utilize from interest expense paid on their mortgage loan. Current law allows interest expense paid on a mortgage loan as large as $1 million to be tax deductible. Under the new bill, the amount of interest expense paid on a mortgage loan as large as $750,000 will be tax deductible. The impact of this provision is that the current interest tax shield on the portion of an outstanding mortgage loan amount between $750,001 and $1 million will no longer have any value for purposes of reducing a homeowner's taxable income amount. Second, the personal income tax standard deduction amount will increase. The bill increases the standard deduction amount for taxpayers from $6,300 to $12,000 for single filers and from $12,600 to $24,000 for joint filers. The impact of this provision is that most homeowners will be better off utilizing the standard deduction to reduce their taxable income amount rather than itemizing their mortgage interest expense for purposes of determining their taxable income. As an example of the impact of the increase in the standard deduction amount, prospective homebuyers need to know that the median home price level for the end of the fourth quarter was $205,100 according to Zillow.com. In addition, the prevailing quarter-ending mortgage loan interest rate for a 30-year fixed-rate loan was 4.15% according to Bankrate.com. Based on these facts, new homeowners that purchased a median-priced home or of less value using a conventional mortgage loan at 4.15% would only pay a maximum of $8,512 in interest expense. That amount is far less of a benefit than the standard deduction amount afforded to single and joint income tax filers under the new bill. The impact of this provision is that new homeowners that are single filers that purchased a median-priced home or of less value will have a lower income tax obligation using the standard deduction amount if their mortgage loan interest rate is less than 5.86%. And joint filers that purchased a median-priced home or of less value will have a lower income tax obligation using the standard deduction amount if their mortgage loan interest rate is less than 11.71%. Third, the state and local income tax deduction amount has been restricted. The bill caps the amount of taxes that can be used in order to reduce a homeowner's taxable federal income amount to a level that is not to exceed $10,000. Currently, taxpayers may deduct from federal taxable income all of their state and local property tax, as well as either their state and local income taxes or their sales taxes. The impact of this provision is that the federal government will be out of the business of subsidizing the states. As a result, wealthy homeowners in high-cost states such as New York, New Jersey, and California may experience a higher income tax obligation due to this provision of the bill. Moving away from these policy issues and events to an assessment of the mortgage lending environment, it is important to note that for the fourth quarter of 2017, the national average mortgage loan interest rate for a 30-year fully amortized fixed-rate loan began the quarter at 4.07% and ended the quarter at 4.15%. Since June of 2011, the national average mortgage loan interest rate for a 30-year fixed-rate loan has been less than 4.61%. In order to better assess the current mortgage loan interest rate environment, prospective homebuyers should remember that the national average mortgage loan interest rate for a 30-year fully amortized fixed-rate loan reached an all-time low of 3.31% in November of 2012, and it reached an all-time high of 18.63% in October of 1981. In view of realized and expected labor market conditions and inflation, the Federal Reserve elected to raise the range for the target federal funds rate by 25 basis points from a range of 100 basis points and 125 basis points to a range from 125 basis points and 150 basis points during their Q4 2017 Federal Open Market Committee Operations meeting. Prospective homebuyers should closely follow the level of mortgage loan interest rates in their community, because a rising cost of debt will increase the amount of interest expense that prospective homebuyers will need to pay for their mortgage loan. This in turn will place downward pressure on the price level of residential housing in their community. Prospective homebuyers should use the Atkins Residential Home Valuation Analyzer in order to assess the impact of a changing interest rate environment. Now that I have provided an overview of the events and trends that have taken place in the residential housing environment for the quarter, let me turn your attention to the proprietary finance-based analytical methodology and cloud-based residential real estate analysis software application that you can use in order to provide an assessment of the price level of homes in your community. The Atkins Residential Home Valuation Analyzer is an internet-based software application that analyzes the relationship between the median home price level for a city and the median household income level for the city. With this information, the software application takes into account the most recent month-ending national average mortgage loan interest rate for a 30-year fully amortized fixed-rate mortgage loan and the assumption that no more than 28% of pre-tax household income should be spent by homeowners in order to repay the principal and interest costs for their mortgage loan. By utilizing this information, the Atkins Residential Home Valuation Analyzer can accurately assess the price level of homes in your city. From the first analytical perspective, the Atkins Residential Home Valuation Analyzer determines the level of underpricing or overpricing of homes in your city by calculating the mortgage loan interest rate that justifies the price level of homes in your city. With this information, the justified mortgage loan interest rate is compared against the national average mortgage loan interest rate in order to accurately assess the level of underpricing or overpricing of homes in your city. From the second analytical perspective, the Atkins Residential Home Valuation Analyzer calculates the percentage of household income that would have to be spent by the people that live in your city in order to justify the price level of homes in your city. With this information, the justified percentage of household income amount is compared against the traditionally accepted household income amount of 28% in order to accurately assess the level of underpricing or overpricing of homes in your city. By utilizing the Atkins Residential Home Valuation Analyzer, you can determine the level of underpricing or overpricing of homes in your community, as well as the magnitude of underpricing or overpricing of a specific home that you are considering to purchase. This in turn will help you make a prudent home purchase decision. For more information about our finance-based analytical methodology and the use of the Atkins Residential Home Valuation Analyzer, please review our finance-based analytical methodology report on the Atkins Capital Management website and watch the wealth of movie presentations that provide an overview of the Atkins Residential Home Valuation Analyzer. Now that I have provided an overview of how the Atkins Residential Home Valuation Analyzer is utilized, let me provide an overview of the home price level for a select group of cities across the U.S. For the fourth quarter of 2017, 16 cities that make up the Atkins 60 City Home Price Index were classified as overpriced for the quarter. San Francisco, Honolulu, Newark, Bridgeport, and San Diego were identified as the 5 most overpriced cities in the index. While San Francisco and Honolulu had the same justified percentage of household income amount, San Francisco was classified as the most overpriced city due to its higher required median household income level. In terms of a relative price level analysis, it is not possible to justify the home price level for the top 5 overpriced cities by reducing the 30-year fixed-rate mortgage loan interest rate from 4.15% to 0%. Therefore, in order to classify the homes in the top 5 overpriced cities as underpriced, it would need to be deemed prudent by prospective home buyers to spend more than the justified percentage of household income amount. As an alternative, in order to justify the median home price level for each city, the median required household income level would need to increase to a level within the respective range of $71,478 and $169,789. Finally, based on the median household income level, the quarter-ending national average mortgage loan interest rate, and the assumption that no more than 28% of pre-tax household income should be spent in order to repay the principal and interest costs of a mortgage loan, the justified home price level for the top 5 overpriced cities fell within the respective range of $172,548 and $403,975. On the other side of the spectrum, 44 cities that make up the Atkins 60 City Home Price Index were classified as underpriced for the fourth quarter of this year. Detroit, Buffalo, Wichita, Cleveland, Huntington, and Portland were identified as the 5 most underpriced cities in the index. Cleveland, Huntington, and Portland have the same justified percentage of household income amount. Therefore, these cities were ranked according to their justified mortgage loan interest rate amount, because interest rates would have to reach these levels before these cities would be classified as overpriced. In addition, in order to classify homes in the top 5 underpriced cities as overpriced, the national average mortgage loan interest rate would have to increase from 4.15% to more than the justified mortgage loan interest rate amount for each city, or it would have to be deemed imprudent by prospective homebuyers to spend as much as the justified percentage of household income amount in order to repay the cost of a mortgage loan. Given the recent events that have transpired in the residential housing market, and taking into account the fact that buying a home will likely be the largest single financial transaction that prospective homebuyers will ever make, and the bulk of their net worth will likely be tied up in their home, prospective homebuyers should use the Atkins Residential Home Valuation Analyzer in order to analyze residential real estate from 5 financial perspectives. First, prospective homebuyers should use the Atkins Residential Home Valuation Analyzer in order to assess the level of underpricing or overpricing of homes in their community. Second, prospective homebuyers should use the Atkins Residential Home Valuation Analyzer in order to assess the largest amount of money they should spend in order to purchase a home. Third, prospective homebuyers should use the Atkins Residential Home Valuation Analyzer in order to assess the amount of money they would need to earn on an annual basis in order to be able to afford to purchase a specific home. Fourth, prospective homebuyers should use the Atkins Residential Home Valuation Analyzer in order to assess total home ownership costs expressed as a percentage of household income. And fifth, prospective homebuyers should use the Atkins Residential Home Valuation Analyzer in order to assess how much a home would need to appreciate in value each year in order to offset the costs associated with owning the home. By assessing residential real estate in this manner, prospective homebuyers will be able to make a prudent home purchase decision. For more information about the Atkins 60 City Home Price Index, to watch our catalog of residential housing movie presentations, or to subscribe to use the Atkins Residential Home Valuation Analyzer, please visit the Atkins Capital Management website at residentialrealestateanalysis.com. This is Troy Atkins, saying thank you for taking the time to listen to this presentation.